But do you think the so-called Trump trade, just buying domestic, America, buying American stocks is starting to roll over?
Well, it certainly has been in the last a week or so, or a couple of weeks, and it's a little too early to say that this has become a major problem. I mean, and the Russell 2000 small cap index is down 7 days in a row, so it's probably due for a little bit of a short-term bounce. But it does bring about questions about economic growth in 2019. I mean, one of the main reasons that the Russell 2000 is down is it's heavily weighted with the regional bank stocks. And you look at the KRE bank index, it's down quite a bit. And the thing is, you worry about that is that one of the reasons it's down, we all talk about the yield curve, but we also see that loan growth is slowing quite a bit. And that's a concern about what future growth in the economy. And of course, the other thing that's going on is we see the housing stocks into bear market territory now, and there really isn't a more important industry to the U.S. economy than housing. So it brings questions that as the effects of the tax cuts begin to wane as we move into next year, will growth start to slow? I mean, not talking about recession, but will growth start to slow? And with a stock market that's priced to perfection, will that cause the stock market to pull back?
We like good news, but here's the reality. Mortgage rates have jumped by nearly 1% in a year, which doesn't sound like a lot, but it's a couple $100 a month. In a mortgage, you got houses out in California to $1.5 million for a 3-bedroom teardown and 8 times income in Las Vegas. Every time a house is sold, it's tens of thousands of dollars that go into the economy. Moving fees, you buy furniture, you hire a painter, whatever it may be. Is that maybe the biggest warning sign that we're not talking enough about, Matt?
Yeah, definitely. And I think that people are a little bit too complacent about it. I mean, one of the things that people keep talking about, or we hear a lot in the last 2 years, is that the rising interest rates, the rates are still really, really low. So rising interest rates really won't have much of an impact. Well, what's going on in the housing stocks is telling us something quite different. Again, it's a bear market. They're down over 20%, well over 20% now. And, the thing is, we just have to worry about going back to the interest rate thing, is that when interest rates start to get moving up, it doesn't really matter. Stop 1 second. The one thing I'd really say is that every single time the Fed starts raising rates, it has an impact on the stock market. The thing is, there's usually a big lag time, usually 18 months to 2 years. Well, we're now in that time frame in terms of when the Fed started raising rates a couple of years ago. And so as we move into 2019, every single time in the last 50 years it's caused a problem in the stock market. So to think it won't happen this time, I think is a concern, and people are just too complacent about it.
Well, yeah, but the market doesn't seem to care. I mean, every day I come in and I'm like, good morning, America. Futures are up. And then the stock market rises. Yesterday I said futures were down, and the stock market rose. Maybe the market structure, Matt, has changed enough that all the things and the historical sort of anecdotes that we have maybe don't matter as much anymore because ETFs have eaten the world.
Well, that could be the case. I mean, that's one of the reasons why I'm kind of saying that you need to play the market the right way. And I think the right way right now is to getting a little bit more defensive, because as you get these defensive groups, like especially the healthcare stocks, which are a little overbought near term, but I think still have a lot further to run for a number of different reasons, but also the consumer staples, these groups are holding up and actually slightly outperforming the market. So if you get a little bit more defensive right now, you limit your downside if the market rolls over, but you're not hurting yourself on the upside. At least you haven't over the last 5 or 6 months. And the way some of these stocks are acting and the fundamentals behind, especially the healthcare group, that could still work very well. I mean, let's face it, anything can happen. Old Dominion beat Virginia Tech in football this year, so anything can happen.
Oh, you hit me where it hurts, Maley. I appreciated your final ever visit on Worldwide Exchange. I'm kidding. Matt Maley, MillerTabak and Company had to just poke me in the eye. We're going to beat Notre Dame this weekend. We're going to beat Notre Dame. I'm calling it right now.